The world doesn't trust our treasury market anymore because of fiscal irresponsibility and sanctions like we did to Russia. And Trump saying a 500% tariff if you support Russian energy purchases. Well, that's not a tariff, that's a sanction. They don't trust us. The banks don't trust each other. And now the exchanges, the players within the biggest exchanges on the planet don't trust each other to the point where they say, nah, I'm going to pay more for it right now than I will for it in the future. That is backwardation. That, again, the theme is no one trusts each other. And that's a problem in a world where everything is based upon trust. It is a lack of trust across the board, and that is not what strong economies and resiliency is.
Something enormous just shifted beneath the global financial system, and almost nobody is talking about it. Silver is flashing signals that only appear during moments of extreme stress, backwardation, physical premiums, and immediate delivery demand. And at the same time, the Federal Reserve is quietly pumping crisis-level liquidity into the repo market again. This is not noise. This is not a temporary imbalance. This is what Andy Schectman calls the moment trust finally breaks inside the system. Because when bullion banks, the most sophisticated players on Earth, are suddenly willing to pay more for silver today than the price they themselves set for the future, you are witnessing a crack in the foundation. Tonight, we're going deep into what this means, why it's happening right now, and what gold and silver investors must understand before the next major market move hits.
Something is happening in my mind beneath the surface of the financial system because over a 5-day stretch over the last 2 weeks, the Federal Reserve injected $125 billion into the repo market. And the popular talking heads would say it was to ease funding stress, as we saw in 2019 with the repo market problems, in 2008 with the fail of Lehman Brothers and the great financial crisis. But it's important to understand that $125 billion, especially over a few days, over a period of 5 days, is akin to crisis-like behavior. It's on par with what we saw when Lehman fell. It's on par to the 2019 blowout in the repo market. But let's first kind of try and dumb down what the repo market is. It's the plumbing of the financial system. And it's where banks, big banks, lend to each other overnight, literally overnight. And they do this to keep things flowing, if you will. Normally, this market, you never hear about it, and that's what it's supposed to be. It's quiet. It means everything's working. But when the Fed steps in with huge amounts of cash, mind you, typically, if there's no stress, you won't see much of any movement in the repo market or usage of it. If there's a little bit of stress, you might see $3, $4, $5 billion put into it or trading in it. If there's moderate stress, maybe 10, 12 billion. At 125 billion, it's the equivalent of hearing loud banging noise every time you turn your water on in the walls. Something's not right. Something's not flowing right. But what makes this concerning and very different than what we saw in 2008 and 2019 is that in 2008 and 2019, it was an issue of liquidity or lack thereof. Now, this is not a we're out of money problem. Today, the banks the big banks that would trade in the repo market actually have twice the reserves that they had during the 2019 repo crisis. And in this environment, the Fed would rarely, if ever, inject liquidity into the overnight market when reserves are this high. In this environment, repo injection should be near zero because the banks have enough money to trade with one another back and forth. It's just overnight exchanging collateral, typically treasuries, sometimes mortgage-backed securities or whatnot. But this isn't about money. It's about trust or lack thereof. And in essence, then again, banks are looking at each other and saying, not a chance in the world am I going to borrow anything or lend anything to you, or not even for one night. And because I'm not sure you're going to pay me back tomorrow morning. And the reason this matters is because you typically only see repo market stress right before market corrections. It's an ominous sign in that this is all about the lack of trust. And when the most well-informed traders on the planet, the very, very large commercial banks, are saying, you know what, I'm not lending my money into this system. I'll just park it at the Fed instead. I am not going to do it. And you start to see the overnight lending system dry up. It portrays, I think, serious fractures within the entire system and is far more concerning than just a lack of liquidity. It's a lack of trust, which is far more systemic and troubling. The banks are trading with other banks, smaller, regional maybe, and also with large hedge funds. And even though you would think that this would be something that should be easy peasy, it's not. And because now it's a lack of trust, it's also a lack of faith in collateral. We've been seeing a lot of subprime and mortgage-backed securities, not subprime, but mortgage-backed securities rather, used as collateral. Now you would do that after you've already, I mean, you're doing that because you don't have treasuries or you don't want to trade your treasuries. You're trying to give the collateral that is less than perfect, so they don't trust the collateral and or they don't trust the partners. That is not a good thing because you're trading overnight. You're talking the most liquid, safe, secure trading platform on the planet. You can't get more conservative than trading overnight with the big banks and using a collateral that is, either mortgage-backed securities, which are bundled, or treasuries. And this portrays that the system itself is rotting from underneath. And the big players know this. It's concerning for sure. And I think people should keep a close eye on it. If this was a problem of lack of liquidity, it would be less concerning to me than a lack of trust. Trust is a hard thing to get back, and the people at the top see the picture better than anybody. They understand exactly just what kind of clothing the emperor is wearing, I guess you could say. And for them to not trade in what is the most conservative, easy trade you'll ever find overnight because they don't trust the system, it's an indictment not just of the trading partners, but of the liquidity or the solvency of the trading partners and also the value of the collateral. And I think these are two very, very dangerous topics when you talk about what it means. It means that the Fed will typically in this environment be forced to come in and intervene whether they want to or not. And when you already have inflation running much higher than the CPI tells us, we can all feel it with the grocery bills and all of our other bills and our paycheck not going as far. It could really be if you will, the match that lights the fuse, not only to inflation, but the systemic problems that could chain, domino all the way down if they don't step in. So yeah, it's something people should really, really pay close attention to. And if the banks don't want to lend money to other banks, what does it say about keeping your money within a banking system? What does it say about the systemic risks within the banking system itself? I think people should think about that as well. This is one of the things that we've talked about a lot on your show, is just how safe is the banking system with the change to Universal Commercial Code, with the great taking by David Rogers Webb, with being an unsecured general creditor over the FDIC limit. All of these things we've talked about, bail-ins versus bailouts, for a long time, this is how it would start. In essence, this is where the trouble starts before the stocks get wind of it, before the credit markets get wind of it, before the media gets wind of it. It starts right here because you're talking the most well-informed traders on the planet that are making these decisions.
What Andy Schectman is describing isn't just another financial headline. It's the kind of quiet shift that only reveals itself to people who know where to look. And if you zoom in on the timeline of the past few weeks, the story becomes almost unbelievable. It starts deep inside the repo market, a place most people never hear about because it's supposed to be silent. It's the financial system's heartbeat, the overnight pulse where massive banks lend to each other just to keep the global engine running smoothly. But then, something strange happens. The heartbeat skips. Then, it thunders. Over just 5 days, the Federal Reserve quietly pours $125 billion into this hidden pipeline. Not because banks ran out of money, but because they no longer trust each other enough to lend for even one night. Imagine the world's largest financial institutions looking across the table, shaking their heads and saying, "No, not even until morning." That's when you realize this isn't about liquidity. It's about fear. And just as that fear starts to spread through the bloodstream of global finance, another signal flashes, this time from the metals market. Silver, long treated as the boring little brother of gold, suddenly behaves like something alive. The futures market, the place where paper silver trades, begins to twist. Spot silver starts trading above futures. Backwardation. That almost never happens. Not in silver, not this close to delivery, not unless something underneath is tightening or breaking. This is where Andy's warning hits full force. The market is screaming that someone, somewhere, needs physical silver right now. Not next month, not after delivery, now, and they're willing to pay a premium to get it. Picture this. In a world built on paper contracts, digital entries, and promises buried in settlement systems, one asset cannot be printed, duplicated, or simulated: physical metal. When trust dies, the oldest form of collateral becomes the most valuable. Now layer in the rest of the world's story. Countries dumping U.S. treasuries, the dollar losing friends, sanctions weaponizing the currency system, central banks buying record amounts of gold, and major economies quietly building alternative settlement networks outside the West. It's like watching the global financial order shift 1 inch at a time, until suddenly the ground moves beneath your feet. Andy's message to investors is not a prediction, it's a warning shot. When trust breaks, markets don't bend, they snap. And those who positioned early in physical metal, the kind you can touch, the kind no one can print, will not just preserve wealth, they'll be on the right side of one of the most dramatic revaluations of our lifetime.
So I think we're either 9 or 10 days away from where holders of the December gold and silver contracts have to, it goes into delivery at that point. I think it's the 28th of November. This is where you could say, instead of the rubber meets the road, it's where paper meets physical. Those who want to stand for delivery can on the 28th. They don't have to do it on the 28th, but this is when typically they'll declare, yes, we're going to stand for delivery. And when you look at gold right now, it's business as usual. You have spot right now. I looked this morning, it was like $1.60, I think, over the December futures contract. And that is classic contango, right? And so you have the futures price is going to be, and it's actually under the December futures contract. Spot is about $1.60 under the December futures contract, which is classic contango, which means the further out you go, you're supposed to pay a higher price. And that takes into account things like storage, interest expense, the cost of money. So in other words, if the spot was 4,100 an ounce, it would be 4101.50, something like that for the December futures contract. As we get much closer to the end of the contract, when you can stand for delivery, it should get narrow and narrow and narrow and get closer to 1-to-1. The further out you go, the larger that contango, the larger that interest expense, the larger the cost of storage. That's normally how it works. So if you go a year out, it may be $25 an ounce more because of the cost of money, the cost of interest, and the people who are betting on it says, yeah, it's going to be $25 higher in a year. That's contango. Backwardation is something you don't see in the metals market very often. It's where the spot price is over the futures price, not under like gold and contango and normal market, but over. And that's backwardation. And it's rare, especially this close to expiration. What it basically says is someone wants physical silver now, not later, and that they see tightness in inventories and immediate demand is outpacing the expected supply. In other words, I don't care what the futures say, I will pay more for it today. I don't want to give you, kind of like what the banks are saying. I don't want to wait one day. I don't want to wait any time at all. I want it right now. And this kind of spread, especially as we get close to expiration, doesn't happen unless something's off. And it usually comes right before a big move in the metals market. So I think it's interesting to see, this is what we've been talking about for a long time. Now, for a minute, we saw the market when 50 plus million ounces found their way to London. We saw the market shift from big backwardation as much as $3 an ounce to contango as it's supposed to be, lasted not more than a day or two, if that. And now all of a sudden we're back in backwardation again. And that just simply says a lack of trust. And this is a theme we see everywhere, whether it be the leaving or the dumping of treasuries by countries like Japan, who has its own problem right now with the $110 billion stimulus package that they're throwing out because the yen is collapsing to a 35-year low. But you're seeing it with, the world doesn't trust our treasury market anymore because of fiscal irresponsibility and sanctions like we did to Russia. And Trump saying a 500% tariff if you support Russian energy purchases. Well, that's not a tariff, that's a sanction. They don't trust us. The banks don't trust each other. And now the exchanges, the players within the biggest exchanges on the planet don't trust each other to the point where they say, nah, I'm going to pay more for it right now than I will for it in the future. That is backwardation. That, again, the theme is no one trusts each other. And that's a problem in a world where everything is based upon trust. And if the trust is eroded, if your wife cheats on you, how long does it take for you, if ever, to get that trust back? Now, that's a bad analogy, but the point is the same. You know, we are a country, we're the good guys. We were based on, a moral high ground and doing the right thing. And you could argue whether it be the constant political bickering, whether it be, the way the world looks at us, being in Iraq, yet passing judgment for 22 years, mind you. We're still there. We never found the weapons, but the way we passed judgment on Russia. Now, I'm not making making a statement on either, but I'm just saying the world looks at us as being hypocritical. And the treasury market based on trust with massive fiscal irresponsibility and countries wondering if they're going to be the next one to be sanctioned, everything seems to be eroding in terms of trust. When trust in institution, in currency, in the judicial system, even all the way up to the Supreme Court. Look at what's happening on the Federal Reserve. We don't trust them anymore either. We're finding the members of the Federal Reserve are doing illegal things that we would go to jail for, but they just get fired from the Federal Reserve. It is a lack of trust across the board, and that is not what strong economies and resiliency is born from. In fact, quite to the contrary, to me, it is far more discouraging and threatening to this system than just about anything else.
We are entering a phase where trust, not interest rates or GDP numbers, will determine the next major shift in gold and silver. The repo market, the treasury market, and the futures market are all flashing the same signal. Someone big is losing confidence in the system's ability to deliver. And when confidence collapses, physical metal becomes the final anchor. If this analysis helped you understand what's really happening beneath the surface, make sure to subscribe, because the next few months could redefine the gold and silver markets for years to come. My question for you: do you think silver's next explosive move will be triggered by physical shortages or by a systemic trust crisis in global banks? Drop your answer below. I want to hear what you think.